Hey, and welcome to Why Predictable Cash Flow Matters. This 30-40 minute webinar, really just want to share with you some insights, some ideas, and some focus really on why predictable cash flow matters. More interestedly, certainly from my experience in the decade that I've been working with business owners and the 2 decades that I've actually been a high performance coach, this seems to be one of the biggest challenges for business owners more often than not. I guess a topic, a conversation that often results in actually putting our heads in the sand and not engaging, not looking at, and by virtue sometimes coming up against challenges and problems which are wholeheartedly avoidable. And I'll go on to explain a little bit more about that as we go. But what is it that I really want to look at is, if you look at your business and the essence of cash flow in business today, the challenge for most business owners is, at the end of the month, have I balanced the books? Have I, made enough revenue? Can I hit the wage bill? Am I able to, pay my bills? Am I able to pay myself? And sometimes it can just be a really challenging act. And it doesn't need to be that way. Cash flow in the very simplest terms is, the inflow and the outflow of money in your business. It's how money flows through your business. But where we're able to start looking at predicting cash flow, which you can, and I'll go on to demonstrate that as we go through today, you can have a significant impact on, the productivity, the efficiency, the profitability, and the growth of your business. It matters significantly because cash flow is in essence the lifeline of your business. If you want to think about it in the context that, I'll talk about this again later on, but if you run out of cash in your business, you can't do business. It kind of affects everything. So let's put this into context. There's a phrase out there called growing broke. You may or may not have heard of that, and it's not meant to sound flippant or anything of that nature, but really growing broke is where you run out of money. You don't run out of business, you run out of money. So if you don't have enough cash flow, and as we'll come on to see later, operational cash flow to actually pay and fund the business that you're in and the business that you do, whether that's supplying products, whether that's a service, then there is a likelihood that you will run out of business, or run out of money, and go out of business. And I'm sad to say that I've seen that on a number of occasions. Now, the reason that I was inspired to offer this webinar specifically is because, let's be honest, let's look at the very current environment. The narrative that you're listening to through the media at the moment is one of recession around the corner, the living crisis, the cost of living crisis, and supply chain. It seems that since we got through COVID, we're now presented with other crises. And the point I think here is actually that doesn't need to be the way. You can actually shore up your business, protect your business interests from that, just through some of what I'm going to discuss with you today, having a higher awareness and actually taking the actions necessary from some of the strategies I'll share from today's webinar. So, predicting prosperity, cash flow forecasting. I mean, the first thing I would say is, when we look at cash flow forecasting, there is the context that cash flow forecasting, in many respects, is a work of fiction. We are predicting the future, but the fact of the matter is that we can actually go some steps to anticipate the inflow and outflow of business. So, for instance, what bills you have to pay. What regular bills you have to pay, our expenses. You'll know that you need stock, or you need material, or you need to have subscriptions for your services, or a support team for your services, or team that you're paying. The bottom line is, your business costs are predictable. You might well have, repeat business, in which case you know that customers are coming. So you've got, regular footfall, for instance, if it's a retail business, or you've got a subscription model if you're providing something, or, if you're manufacturing something, there are, the quantities that you're providing to, regular customers. So there is a predictive nature to, putting together a cash flow forecast. The purpose of it actually it allows us to really tune into the operating needs of the business, to make sure that we have enough funds to actually run the business, and more importantly, to grow. When you think about this, actually, if we need to grow, then we need to do business well. We need to sell well. We need to market, and some of those things, in fact, all of those things require financing. Require us to be able to put a real focus in terms of how much that's going to cost the business in order to do the business, to make the profit. And the other thing is forecasting, and I think this is the most critical element. It allows you to see the train crash that's coming around the corner, and this is where they are wholeheartedly avoidable. Often what happens is we're just looking at our bank account. We're looking at it regularly. Some will be looking at it every day. We'll be juggling what's coming in, what's going out. And then suddenly something will come up and I've got a massive invoice to pay. I've run out of cash in the business. I don't have enough cash to pay it. And suddenly there is a bit of a train crash that is looming. And often it's not so much it's looming. It's you're right in the middle of it. How am I going to deal with this? How am I going to do that? And suddenly we then start to think about, well, I need to get a loan, or I need to get an overdraft facility. And we feel the pressure. It creates the stress in the business. Well, the point here is when we start to put predictive, cash flow in place, when we put a cash flow forecast in place, you can start to see the potential of those train crashes coming. Now, the interesting point here, and remembering that we're all of us tax collectors for the government, you can have a conversation with HMRC to defer payments, and HMRC will be supportive. I don't think I've come across a case yet with anybody I've spoken to who's had a conversation with HMRC where they've not been supportive, and that that they will help you get through any challenging period. They won't let you off the tax. They won't say, don't worry, this quarter don't pay us. You'll pay your tax because that's the appropriate thing to do. But they will help you so that it doesn't become a burden and result in the business going south. Your banks. It never ceases to amaze me that sometimes we won't go to our bank and say, look, I've got a challenge that's coming up. Would you be able to help me? I need a bridging loan just to get over this period of time. I need a growth loan because we're stepping up our game a bit, but I can see that there is a point in a month or two where I'm going to have some challenges. And what's really interesting is it goes back to the proverbial head in the sand again. I'm not going to enter into that conversation because that's kind of a scary conversation. And what if they say no? Well, what's the one organisation that knows intimately how the money moves through your business? There is no secret. They can see what's being spent, what's being brought in, what the revenue streams are, what the expenses are. It's your bank. And so, that first stop to have a conversation with your bank will more often than not be able to help facilitate a period of time to get you through that. And then outside of that, there are a host of different areas where you can then start to, put precautions or, contingency in place to be able to deal with, these type of challenges. So forecasting is great for growth. It's great for, seeing any challenges that's coming up there. It's great to, predict market share, market growth, and how you can actually do, get the business going in the direction that you want to go. So hopefully those two, introductory pieces gives you the insight as to the importance of your cash flow forecast, and why I'm going to share with you a whole series of aspects here where you actively can create your cash flow forecast and then use it as a growth tool in your business. Okay, so let's have a look and a dive into some of the deeper context. Your P&L, your profit and loss, or your profit and liabilities report, is more than just a set of numbers. It is an incredibly valuable document that we can utilize to help actually define our cash flow forecast and then monitor and manage and maintain it. So as a financial report, it summarizes that move of revenue and expense in your business. It gives you a very clear focus in terms of what money's moving through your account. And the bit that I would say is straight away, if you're going to grab the gauntlet and go for creating a cash flow forecast, then print out your last 3 months, or better still, print out your last 6 months or year to date, month by month P&L statement. Now, if you are sitting there going, well, I have no clue how to use my Xero, Sage or QuickBooks, trust me when I say that if you go on there and look logically at the tabs that are on there, you will find your reports, and then from your reports you will see that P&L will be a standard report, and then you'll be able to see that somewhere there will be a drop down where you can customize the reporting period, and then you'll be able to actually set up a 6-month report. Print it out month by month and line entry, so you can see everything that's moving through your business, because that's going to be the first thing that will make a significant difference and assist in actually creating the cash flow forecast. Your P&L, actually, when you look at it as well, you'll see that it gauges the performance of your business and just actually how well are we doing. You can see the ebb and flow, and it's the historic data is an incredibly good example of what your future data is going to look like. Your cash flow forecast, in many respects, if you look at your P&L statement by month over the last year to date, you'll see the ebb and flow of money. You'll see what went in, what came out. But then when you look back at it, you'll recognize, well, that was when I was having a bit of a challenging period. But then when we're able to look at those numbers, create and understand the averages, know what our monthly expenses are, predict or focus on what we know is coming in, and predict or target our business going forward for the revenue, suddenly we can start to really create a fairly decent working cash flow forecast, and that becomes the budget and your targets. Okay, so beyond the numbers, I think, as I mentioned there, it helps with formulating strategy. It helps with getting a focus in terms of what has been and actually what we can learn from that to go forward. And as I just mentioned, it is really about helping to forecast, your growth. And so by that you can set your targets, your sales targets, and actually they're not set on kind of like sticking your finger in the air and seeing which way the wind's going, but rather on a prediction based on what, actually this is what we've done year to date. This is what's worked. So actually, if we then apply a little bit more to this marketing strategy by, reason, then that's going to generate more leads for us, and by reason that's going to generate more conversion for us, and that's going to mean that we can hit this target. So you start to see that P&L is probably the most critical and useful document that you've got to actually sit down there and create a cash flow forecast. Do you watch the Dragon's Den? And are you like me when the entrepreneur's standing there, got a fantastic idea, and one of the dragons turns around and asks them, okay, so what is your gross profit? And the challenge is that they often turn around and they'll come out with a figure that the dragons will very quickly work out that that's their net profit, or it's their operating profit, and actually they miss the point in terms of what their gross profit is directly. So why is gross profit important to know. And I think actually Dragon's Den's a really, really good example of gross profit and what it's all about. And I'll try to explain that, because it's one of those things that, in the UK, firstly, our tax laws are so complex. They're probably the most, if not the most complex on planet Earth. But the other side of this one as well, what's really interesting is accountancy can feel like a dark art, with the level of understanding, just in terms of, I'm only talking about cash flow, and everybody listening to this today will know what cash flow is. Absolutely you do. You know what's coming in, you know what's going out. That's cash flow. And yet it kind of like feels like, well, I'll leave that to my accountant. You don't need to. But you also don't need to be, bamboozled by some of the terminology. And I want to try and put this in the very, very simplest context as I can. And I get, I don't want to mean to offend any professionals out there. I know there are deeper complexities to what I'm going to talk about here. But when we look at gross profit, in the very, very simplest terms, gross profit is your revenue minus the cost of goods sold, or your cost of services sold if you're a service provider. And so what does that mean? Well, it means that I've got a product, a widget, a service that I sell for a particular price. Now, you'll have already worked out your price, because you'll have worked out how much it costs to provide it, and then worked out, well, actually, I then can add profit to that, or a margin to that, and that's where my profit sits. Now, the interesting point on it, in the very simplest terms, that is gross profit. Cost of goods from your revenue gives you your gross profit. But what is gross profit? An important metric to know and understand. Well, going back to the dragon's example, a dragon that's interested in your business is only really interested in, actually the revenue, how much you're making through what it is that you do, and directly how much it's costing you to do it. So the cost of your goods sold. And that gives them the gross profit. So if they can see that you've got a really good gross profit in your business, they're not really interested in anything else in your business. And that's not because they're highfalutin or the all-knowing oracles, although they are incredibly knowledgeable. It's because they don't need to take on your marketing team. They don't need to take on your sales team. They don't need to take on your expenses. All they're interested in is actually that your offering has got legs. And if they then decide to become a partner with you, they will have leverage in increasing that gross profit, because they have effective marketing. They've got great salespeople. They've got resources and supply chain that they can utilize, or drop shipping, or whatever the case might be, to truly leverage what it is you do. So they're interested in terms of how much gross profit are you making. Is this service and this product that you're offering making money? And that's why gross profit is an incredibly valuable number to know. And I think also when you look at it, if you go forward, I don't know what your vision is, I don't know where you're heading to go, but one of the things that you could be and should be thinking about is, what's the value of my business? And gross profit gives you that value. And it means that if you've got a good gross profit in your business, then your business has got an intrinsic value to somebody. And it might be that at some point you decide to sell it. And when you sell a business, well, we're then entering into a whole different realm of, again, the revenue return, the multiple return on what your business is going to be worth. So hopefully you can see that getting really tuned into your gross profit is incredibly valuable. It shares quite a lot of information in terms of the value of your business, the function of your business, the scalability of your business, the strength in terms of your business model. So that was gross profit. So let's have a look at managerial responsibilities in cash flow. And I'm going to draw your attention back to the P&L sheet momentarily. One of the things, now whether you've got a team or it's just you, the managerial responsibilities is a point that we often overlook. We don't really take a look at. And this is where understanding your cash flow forecast is really important, because you can start to create managerial responsibilities. So what do I mean by that? Well, You've printed out your P&L sheet now. You've got it over the year to date. You've got the line entries. Now, think of every single line entry in your P&L as a managerial responsibility, both in the profit and in the loss and the liabilities. So, who's responsible for increasing sales and the revenue entries? Who's responsible for customer care? Who's responsible for repeat business? Who's responsible for managing subscriptions, increasing subscriptions? Who's responsible for looking at upselling? In terms of what you do? Who's responsible for actually taking a look at are we selling everything? Are we giving away the crown jewels, which is often the case for a lot of businesses, rather than looking at the fair exchange of value and how we structure that going forward? Who's responsible for the cost of goods in your P&L? Who's responsible for sourcing material, for looking at those levels of expense coming through, for actually renegotiating terms? Again, what's that responsibility? And then who's responsible for managing our expenses? And then on the expense side of life, we have got a series of variable costs. So are the variable costs all required in the business? Are there better terms and conditions that we can go to a business to, that's supplying, whatever those variables may be for us? And what about the fixed costs? Is there a date in the diary where somebody's going to actually go back and negotiate our new phone terms, our new mobile terms, our new insurance, our new rent agreement, whatever those might look like? But if you then start to think that every line entry in your P&L offers a source of improved revenue. And so we can start to look at the budget allocation here. We can start to look at revenue tracking, and we can start to look at expense management. And it makes a really big difference. And at the end of today, I'm going to share with you 7 areas where we can focus on what I'm going to call the marginal gains to actually have a significant impact on this. So operational versus net cash flow. So the point that we were talking about, when we look at that operational cash flow in the business, what we're effectively looking at is the money that we generate, from the core business in operations, so that we can actually continue to operate. That's why it's called operating cash flow or operations cash flow. Now, a point here when you look at your cash flow forecast, how much does it cost you to run your business? Just to open the doors, before you do any business at all, what is that costing you to do business? Because that figure is really, really important. If you know what that figure is, firstly, that's going to be your, where your break even comes in. So, you've got to do that much business before you're making profit, your break even. But more importantly, and again, this is something now that everybody in business, pre-COVID has experienced, is what happens if the proverbial hits the fan? And the point here is that actually, if something of that nature is, do we have contingency? Have we got a crisis plan in place? And importantly, what I'm going to talk about here quickly is, do you have debt headroom? Have you got enough capital in the business to just cover actually the downturn in business? If your business starts to stop, starts to plummet, if it's turned off on the 23rd of March because COVID hit, have you got enough capital in the business to run? And for what period of time? Now, often when I work with my business owners, that we often look at 3 months, 90 days. So if it's costing you £5,000 a month to run your business every month, then actually debt headroom of 15,000 is going to give me 3 months of operational cash flow to actually turn that around, to pivot, to do something new. Now, if you think about that in the context, even a historic context of COVID, that's probably more than enough time to actually see you through, and to re-establish fresh business, and to protect the interest of the company. So understanding that operational cash flow is really important. Net cash flow is kind of like, it's a real indication of I guess the growth of the business. So the very easiest way to look at it is, in January this year or last year, how much money did you have in the bank? How much profit had you accrued versus where were you this year? Had it grown? And that's the net growth. So you can look at net growth on a monthly basis, weekly basis, you know, or an annual basis. But that net growth, that net cash flow is kind of like, that's the totality of the growth in the business, and what you know, what your business is looking like in terms of growing going forward. Why it matters? Well, it matters because it helps with you know, understanding the liquidity in the business and looking at the future growth potential. So you may have 1 month where actually, you know, it's pretty bad here. It's not looking good. You know, we're going to have to go in and get you know, a bridging loan to support our growth over this particular month. But if we do that, we know that at the end of the year, our net growth way outgrows the you know, the challenge of having to get that loan in. And so understanding the difference between the two is really valuable. So let me now share with you some action plans and some next steps, and then I've got 3 areas that I want to focus on here, and then I'm going to share with you the, you know, the marginal gains, the power, what I call the power of one. But let's first look at actually 3 very simple but immediate actions you can take. Review your cash flow statement monthly, regularly update and forecast it. So go get your P&L out, print it out for year to date, last 3 months, 6 months, whatever's going to be, you know, appropriate for you. Look at the averages and then build out a cash flow forecast. Once you've done that, look at the medium term, optimize your expenditure, look at, you know, diversifying in terms of the revenue streams, look at not giving away all of your value. You know, think of the fair exchange of value. If you're giving away too much in one hit because you want to be, you know, competing on price, then it's a race to the bottom. But if you want to really focus on this, then look at the value side of life, but then start to really look at your revenue streams. And again, there's a whole conversation we can have on that separately. And then look at that long-term vision. You know, where are you looking to aim in terms of, you know, the growth of your business? And why not be a little bit lavish here? Go put in you know, a 12-month cash flow forecast. And that's what I challenge and, you know, encourage all of my clients to do. You can do it. And actually, you'll be quite surprised what it does in terms of generating a little bit of inspiration, what it does in terms of generating activity and action, what it does in actually reframing your mindset to, you know, target that growth to, right, if that's what I've done and that's what I'm going to do, how do I do it? So let me just share with you now a little bit about the power of one. And the power of one is, again, everything I've talked about here doesn't need to be big numbers. In order to add zeros at the end of this, we need to focus on the marginal gains right now. And so I've got 7 areas that I just want to share with you in terms of the power of one. The first one is price, and you own this. So right now, if you want to have a positive impact on your cash flow, on your operating cash, then put your prices up. And the reality on this, if you put a small percentage on your price, 1% across everything that you do, the likelihood is your clients won't even notice. The cautionary tale on this one, and again, the supermarket analogy is a great example of this, is always remember the end of aisle items. You know, an end of aisle item, the milk, the chocolate bars, the, you know, the cheeses, whatever that might be. You know, you go in the supermarket, you get the idea. You put the prices up on those, your customers are going to know straight away. And that may raise concerns. They may ask questions. But your aisle items, and again, whatever that looks like in your business or your aisle services, probably don't know what that's costing. And so by virtue, actually putting the price up on those has minimal to limited impact. So when we start to look at this, putting your prices up, you own. So number 2. Well, number 2 is about actually increasing the volume percentage of business that we do, and focuses here on a couple of areas: lead generation and conversion rate. So the right way round on this one, by the way, is you've got to make sure your conversion rate is good. So if you're already leaving leads on the table, you're not converting enough, you're not converting well enough, and you know, if you're only converting 25%, then that means you've got leaving 75% of business on the table. Then focus on your conversion, and then focus on the lead generation. If you focus on lead generation without focusing on conversion, then you're just opening the tap and taking the plug out of the sink. And sadly, that's going to cost you money and actually can have an adverse effect. So look at volume. How can we increase volume? And again, marginal gains. The small percentage numbers here make a big difference. Cost of goods and direct costs. Go through. We've already talked about that managerial process on your P&L. Now go through it and think, right, how can I save small percentages on every line entry? Now, if you look at that, if you look at how you can stop spending your own profit through your expenses, if you look at how I can, be more effective in offering what I'm doing. We've already looked at price increase. Now we're looking at actually cost of goods and direct cost decrease. Then suddenly you'll be making more profit and improving your cash flow. Look at the overheads of the business. What overheads have we got that we can have a look at in terms of actually limiting, of cutting back on? And then these ones I'm going to put up together, the last three: accounts receivable, inventory and work in progress, and accounts payable. And the reason on these is, actually this revolves around how effective are we. So in terms of my creditor days, so that my suppliers, what are the terms? Can I go back and ask to shift the terms by a few weeks or a few days? So if I've got, I'm paying my supplier 60 days or 30 days end of month, can I go to 60 days? Can I go to 45 days? Could I go to 65 days? In terms of the inventory, how much inventory am I holding? Can I become a lean business? Am I able to actually, look at the work in progress? Is there something that I can do that's actually going to create that work in progress getting completed sooner than later? And in terms of actually how soon do I get paid, by the way? Do I take a deposit? Am I paid in advance? Is it paid, and am I giving them, my customers the same deal as I'm giving my suppliers are giving me? When you start to look at balancing these out, what we end up focusing on, again, there's a whole nother subject here, but it's the cash gap. You've got to pay for everything, then wait a period whilst you deliver it before you get paid. An example of a business that has an amazing focus here is Dell. And there'll be other businesses like it as well. But what they do is they have I think the last time I kind of had a look, and it's probably when I bought my own laptop, was they've got a 21-day negative cash gap. And what that means is you're paying for your laptop in full 21 days before you receive it. Now just think about that for a moment. What does that look like for you in your business right now? So when we start to look at the power of one, then you can start to see that actually the marginal gains in each of these areas can have a significant impact on you and your business. Well, look, that rounds up really why predictable cash flow matters in business, and I hope that's been a valuable webinar for you. I hope it's been valuable in terms of the content that I've shared. If you would like a templated Excel sheet, and I don't profess to be an Excel guru, but we have a very basic sheet that is highly good at creating and helping you to structure a cash flow forecast. And if you would like a cash flow management document, so we've got a whole document on cash flow management, so it's full of different strategies to start improving cash flow, full stop. Then drop me an email. I'll put my email at the end of this. Go on the email, drop us an email, just put predictable cash flow or cash flow forecast or whatever, just to trigger me so I know what you're looking for. And guess what? I'll send it through to you, and encourage you to go out there and get a real handle on how cash is flowing through your business and how you can predict your future. Thanks a lot, and goodbye.